around 90% of property investors never get beyond 1 to 2 properties, which unfortunately is never going to get them to the financial freedom that they're looking for, and it puts them in a situation where they've got all of their investment eggs in a high-risk basket. Now compare this with the 1% of sustainably successful investors who invest in a way that enables them to live life on their own terms and achieve their version of financial freedom. So what separates the best from the rest? Well, quite simply, as you're about to hear, they focus on building a diversified portfolio of properties. So what does this actually mean? And why is this important? Well, to reveal this, we're joined again by Rasti Vaibhav, the author of the highly acclaimed book, The Property Wealth Blueprint. And he's the founder of leading national buyers agency, Get Rare Properties. So welcome back to the Property Hub's Realty Talk show, Rasti.
Thank you, Bushy.
Rasti, another great subject to dive into here in relation to diversification, and I think never more important given the market conditions that we are and will continue to experience in the years ahead. So to kick things off, Rasti, what's your definition of a diversified portfolio?
Sure. First of all, I'll say that when we're really talking about building wealth, not all eggs in the same basket is the definition of diversification. And what it also means, it's not really just putting all the eggs in the property asset class. It should also be diversified in other asset classes like debt market or share market. When it comes to diversification in property market, I also say that it's diversification not just on the basis of the location, because that's what people think geographically. If I buy one here, buy one there, it's good enough. It's also diversification in terms of the type of the property, whether it's a house, unit, and the likes. Then also the budget or the markets. And what I mean by that is that if you're really targeting the same demography, we are actually kind of dependent on that demography to do well. So if you really buy maybe a middle range, a lower range, low socioeconomic, and then also high luxury. So that's where the diversification can be, buying multiple types, different locations. It's my definition of diversification in property market.
Yeah, I love that. And you make a really important distinction there. That's not just about geography and location. It's the type, the demographics, the budget, so you're really spreading your eggs to a point where if one area or one income level or one demographic's not performing well, there's others that can pick it up. So a really good distinction there. The obvious flow on from that, Rasti, is why is a diversified portfolio important then?
Bushy, if I can say this, there's no free lunch. But the closest thing that can come to as a free lunch is diversification. For the obvious reasons, and the reasons are, it actually diversify for risk. Just like what we know, that Australian property market is not homogeneous, it's actually heterogeneous. We have markets within the markets. So when we buy multiple properties across different sectors, different geographies and whatnot, we are actually diversifying for risk. We are also diversifying for growth, because depending on what that market is doing, like where they are in the property cycle, I mean, the good thing is that when everything is going up, and when you have something more of a synchronous market, you are actually on the top of the market because everything is going up for you. Yeah. But the downside of it is that if everything goes down, I mean, that market is going down and you have all the exposure there, everything is coming down. So the best way as a free lunch in diversification is that you buy in asynchronous markets. What it means is that when a market is going down, a property is not working for you, there's always other property or other sets of properties which are working in favor of you. So what we are doing is, though the property market goes up and down, but when you have a diversification in play, then you actually get to a lot more smoother experience of that portfolio. There's other advantage of that which people tend to overlook, and that is it also gives you an advantage of deleveraging whenever you're doing it. So as an example, if I have to really go out on a world tour, I need some money in my pocket. Now I can really choose from that point of view that what property or what market should I really take the exposure off so that I can really sell it at the right pricing. So it's not really just about buying it low from the diversification point of view, but it's also about thinking where it allows us to exit later on. So it's more of an exit strategy that it really helps us early on.
Yeah, beautifully said. And I think sort of reading between the lines of what you're sharing there with us, making sure that your portfolio is uncorrelated so that they're not all going up and going down at the same time, but you'll have some going up, some going sideways, some perhaps sort of easing, so that the overall exercise means that you're in good position. But you've also then, as you've very well reinforced, got the opportunity to make choices around what you're doing with each property at the right time in relation to where you're at as far as your strategy goes. So, yep, brilliant thoughts there. Sort of going on from there then, Rusty, what are the flow-on benefits of a diversified portfolio then?
Yeah, so when we really talk about diversified portfolio, first of all, what we've just realized is that instead of buying a $2 million property, one asset, what we're really saying is let's go for a diversified portfolio. Automatically, what we are saying, let's use that same budget of 2 million, now buy maybe 3, 4, or 5, whatever your personal subjective numbers comes up with. What it really means is that you're buying multiple properties. Also, it means in a way that you're buying smaller size properties. What it does in a way is that when we really look at the yield number, as in the rent as a percentage that we collect on the purchase price, the yield of a smaller size property actually gets higher or better. So when you go for a diversified portfolio, yield gets better as a percentage. What also it means that because we are not really buying the premium properties of around $2 million, where there's a lot of, the way I look at it, there's a land component, there's a building component, and there's a sentiment value of that. So the more we go to the daily routine property, the sentiment value or the luxury value is actually taken off. So to me, in my definition, a lower end property is a lot more closer to its intrinsic value, which basically means closer to its land plus building value. So you're not really paying a lot more premium, which you're paying otherwise just for the location. Because today there are people who are happy to pay that price. Doesn't really mean that's really the value. But of course, the property investing works in a way that today I'm paying this much price. There will be always other buyer later on because we believe in the long-term growth of the property market. But believe it or not, that's not true. It grows for sure, but the rate of growth is actually different because of the different supply and demand forces playing behind it. So if I really think about the whole, I guess, the thematic behind property investing in Australia and why it is safer is because of the population growth. Now, when there's a population growth is happening, there's a lot more people who are coming as a student in this country or young traders who are coming in this country, and the demand that they have is not for the luxury property, they are actually for the daily routine property whereby they are just looking for a roof on their head. So what it means is not only the yield percentage is better, the growth is better, and also it's much more safer because there's always a lot more demand on that segment. The other thing I would also say is that you don't really have to go and buy 4 or 5 properties at the same rate. What we can say is that whenever you have affordability in terms of the cash flow as an affordability for holding the property, also the deposit that you really need, plus the safety net, for a smaller size property, it's a lot lower. So as an example, if you have to buy a property for about 500K, the amount required in terms of the equity or the cash to buy that property is a lot more smaller than someone who's going to buy a $2 million property. So what it means is that sequentially, it's much more easier for anyone to keep on building the portfolio one property at a time. And because of the virtue of better yield, better growth, that means there's a lot more borrowing power because of the yield, a lot more equity in the portfolio because of the better growth, relatively speaking, and not a lot more risk appetite because that's why they can choose to go more. And also the lender would love that person because they would see that this is more of a business approach that the person is taking, and the lenders would be happily lending more money. So yes, as a broker, you know better that it's not just about the simple DTI, the debt to income ratio. It's more about the credit risk and the collateral and the character, and everything comes into play when it comes to the credit assessment for taking more loan. Because as an investor myself, I got a lot of properties. My DTI income ratio is going through the roof, and people tend to ask me, like, how come when we are really talking about 6 to 8 DTI, how come your numbers are far more inflated from there? And the key is taking this as a business. And when you can really see that you as a borrower is taking it as a business and making money out of it, the lender would also love you because they make money when they lend you money, you borrow money to make money. So then it becomes a lot more easy handshake on both sides.
Yeah, beautifully said. And I think you make a really good point because I've heard this a lot in recent times, Rusty. People asking the question, well, should I buy a one high value property or a number of lower value properties? And as you beautifully said there, property or any investment comes down to supply and demand. Now, If it's more affordable, a lower price, you're going to have more potential buyers and sellers, so that you're more likely to be in the sweet spot, as well as enjoying increased yields that go with that exercise. So some real merit in adopting that approach, which you've explained beautifully. Thanks, Rusty. So to summarise all of this then, Rusty, what are your key takeaways on this subject?
Yeah, my key takeaway, first of all, would be saying that as an investor, it's not just about finding the right property, it's actually about finding the right investment. And sometimes the right property might not be the right investment. So that's where it's more methodical approach there, a lot more strategic when it really comes down to building wealth through property investing. Diversification is certainly the key. And if I really go back to the statistic that you put early in the chat, was that 90% of property investors end up buying only one or two investment properties. But it's only a handful of percentage, like less than 1% of property investors in a country obsessed with property investing. It's only that percentage who's able to build that portfolio of 5 or more properties. Yes, somebody might argue it's not about the number of property, it's about the wealth, or rather the value of the properties. Somebody even, I would even go and argue saying it's not about the portfolio value, it's actually the equity that matters, because that's yours. So really going by those statistics, if you really see that how this less than 1% successful property investors are doing things, and if I can summarize, there are only 2 things that they're doing differently than the average property investor. And if you want to become a successful property investors, I think it's better for all of us to really learn from what the successful property investors are doing. And if I have to summarize in 2 words, that's that of the strategy, which is basically getting a blueprint from where you are to where you want to go, just like a GPS in your physical journey. And the second part is due diligence. Because yes, theoretically, we can learn a lot more about the strategy. We can learn how to fly a plane, but unless we learn with experience and know how to do it, and a lot more confidently we can do it, that's where the due diligence comes into play. So if you can do it right, the strategy and due diligence, I'm pretty sure there will be a lot many successful property investors rather than just generic property investors.
Yeah, well, extremely well said. And something you mentioned earlier in the chat is treating your investment as a business. Rather than just something that's a bit of a sideline hobby. I think that's the discipline you bring to that exercise is going to give you much better rewards. Again, I want to thank you for reinforcing the critical importance of building a diversified investment portfolio, Rusty. And for those of us who've really resonated with your message and want to take action from here, how can Realty Talk listeners get a free copy of your great book, The Property Wealth Blueprint, to help them follow your proven steps to build their portfolio?
Sounds good. So like if it is about getting the book, yes, they can jump on the website, getfair.com.au. And the book is for anyone who would like to learn about the blueprint or the GPS or the strategy around building wealth for themselves or building a robust portfolio, a diversified portfolio. I like the book. There was no such book like that before. That's why I actually took time out to really share my insights on how to go about doing it. So that's what I've compiled. And it's free of cost for anyone who would like to get a copy of that.
Yeah, it's a great book. I've read it myself, and it goes through from woe to go, and does give them that GPS that you're talking about. So I can personally recommend that. So again, you can get it for free. I think you're doing people a great service by giving it to them for nothing, because there's a lot of value in that book, Rusty. So again, if you want to grab yourself a coffee, jump on getrare.com.au, and the website will take you from there to actually allow you to get that copy. So again, thanks for sharing all of this and your words of wisdom here on the Property Hub's Realty Talk show, Rusty.
My pleasure. Thank you so much.